All right, a lot of you guys are freaking out. You guys are like, you can't do private loans. Private loans are bad. The rate's too high. It's unattainable, etc., etc., etc. So I'm going to show you some actual rates, right? So if you look at the actual rates for federal loans right now for medical school, I believe they're around 8%, right? Which 8% really isn't that different from, a private, loan for medical school, right? Even if it's 10 or 11%, 8% is still pretty high. So it's not really that great of a rate, right? What people fail to realize is that they can refinance their private and federal rate later on. They can do it in residency, they can do it as an attending, and once you're a resident or even as an attending, especially as an attending, you have more power to refinance at a much lower rate. And when you decrease your rate, you decrease your monthly payment, how much you're going to pay over the actual loan term itself, et cetera, et cetera, et cetera, right? So it may be a higher rate for 4 years of medical school, but once you have that salary, that income, that proof of future income, right, you're going to have more negotiating power to get your rate lower at a much lower rate in most cases, right? I'm not going to say in all cases, but most cases. Again, for me, I found many places that would happily give me a refinance rate at 5-6%, right? Not uncommon at all. When you have a good salary, people, banks are happily willing to loan you that money, right? They want you to borrow. They want to be the ones that makes easy money because they know that the default rate for doctors is very, very low, right? Now, obviously, your 4 years of medical school, you're not going to be making payments on your on your private loan, right? Because it's going to keep going higher and higher and you can't make payments. But both federal and private loans both grow in medical school because they're unsubsidized federal loans. Unsubsidized, meaning the interest accumulates while you're in medical school, right? Not subsidized. Those are no longer a thing for most medical school students, right? So either way, you're accumulating interest no matter what you do, right? That's just a fact. But in most cases, at least for federal, I'm pretty sure for private as well, that you don't get the whole loan amount dispersed in 1 year. Like you shouldn't be getting $150,000 in private loans dispersed in 1 year. So you're not going to get 10% interest off 150K the first year of med school, and the second year, you're going to be taking out small loans the first year, small loans the second year, small loans the third year, and it's going to add up. Now, it'll get higher over time, but that's what interest is as you borrow more and more, right? That's just logic, right? So I'm going to compare to you basically 3 different things, okay? I'm going to show you the kind of a 10-year term, typical for a 6% rate, an 8% rate, and we'll say a 10% rate, okay? So we'll say the 8% rate is current federal rates, right? We'll say the 6% rate is a refinance rate, okay? And we'll say the 10% rate is the private rate, which again, private rates are going to vary. It could be lower, it could be higher. It depends on you. It depends on your credit score, your credit history, et cetera, et cetera, et cetera. If you use a cosigner, et cetera, right? So I'm going to show you these 3 things to show you back to back to back, how bad is it really going up 2% interest rate on a 10-year typical loan term, right? Again, this is not going to account for any interest you earn during medical school or residency, but just gives you just kind of an idea what to expect, okay, in a 10-year possible term, right? And remember, again, if you have a high rate, you likely can refinance that rate in residency and definitely as an attending, for sure. Again, you'll get plenty of opportunities to refinance as an attending. People are happy to lend you that money, okay? A 12% rate, 11% rate can easily become a 5 or 6% rate.